Hi, so I've been traveling around and talking to different people about INPAG, Exposure Draft 2, and I've found quite a few people are a bit confused or stuck on the grant accounting proposals, and that's kind of getting in the way of them forming an opinion. So I wanted to see if I could demystify these, unpack them a bit, with a view that hopefully you can form an opinion and submit a response. So when it comes to accounting for grants, the key driver is the contents of the terms of the grant agreement or the contract. That's the basic driver of the accounting treatment. You can't decide accounting treatment separate from what the terms of the grant are. So there are basically four different ways that you can recognise income. That's the fancy word that accountants use for when you show the income in the accounts. So one of the first ones is called cash accounting. And that would be basically you disregard what I said earlier about the contract driving the income recognition, and irrespective of what's in the contract, you recognize it when the cash comes in. That's called cash accounting, and that's one way of doing accounting. Another way would be to recognize the income as you spend it. So if I've spent 20,000, I recognize income of 20,000. That's called, it's an example of sort of matching concept where you bring in the income to the extent that you've spent it. A third one is that you could recognize the grant when it's actually receivable. So even before you've got it, if you're confident you've got a contract, you've got reasonable reason to think that it's going to come in, you could recognize that income even before it's hit your bank account. And the last way is similar to sort of customer contract. You could recognize the income as the work is done. So as you're delivering on the requirements of the grant, you recognize income in accordance with the work that you've done. So those are the four basic possible ways. So let's start off by looking at the cash basis. When you recognize the income, you show the income at the same point that it hits the bank account, irrespective of other rules or requirements in the grant agreement. Well, because INPAG is accrual basis guidance, a pure cash basis where you recognize it as you get it, irrespective of other factors, wouldn't be appropriate. Obviously, most donors like to see cash accounting on their grants, and there's a lot of resources on our website. You can see the link there in relation to that. But to recognize income purely on a cash basis within INPAG is off the table. So let's look at this other option of recognizing the income as the money is spent. Well, unfortunately, that one is also off the table because it's called the matching concept, and that was basically discredited as an accounting approach, as an accounting method about 10 or more years ago, because it was causing too much manipulation. And you can massage numbers very easily, and therefore that approach is also out. So we're now down to just two options, two approaches. So one is to show the income as it's receivable, and it's important to say that sometimes it's only receivable when you get it. You can't be sure that you're going to get it until you've got it. So receivable means it could be when you get the money or sometimes before you get it. So that's one option, and the other option is to show the income as the work is done. Now I'm saying options, these aren't choices in INPAG, there's guidance that tells you when you should use one or other of the approaches. So I thought the easiest way to demystify this is to show how it would work with a really simple example. So this is a donor agreement, and it's $100,000 for 2 specific activities. So it's a restricted grant. It's not just an unrestricted donation. For this budget of $100,000, activity 1 is budgeted to cost $40,000. So first of all, we're going to look at this option of how it would work if you accounted for this when the grant was receivable. So when the agreement was signed in January, at that point, they could recognise the income of $100,000 in full, and they've got a debtor. They owed money. They haven't got it in the bank yet, but we've got income and a debtor. Now, here in February, when the money's been received, all that's happened is that $100,000 has moved from debtor to cash on the balance sheet. No change to the income at all. And in fact, the income won't change at all throughout the whole year. We recognised it when it was receivable, and that's it. Next of all, we can see in June that they'd spent $38,000 finishing activity 1. So you can see their expenses of $38,000, which gives a surplus of 100 minus 38 is 62. The cash balance has also gone down to 62,000, and so the fund balance is also 62,000. When we get to December, another 62,000 has been spent. So the expenses for the whole year is 38 plus 62, that's 100,000. You can see the income of 100 minus the expenses of 100 brings us to a surplus of 0, and the cash has also all been spent, and the fund balance is 0. Now we're going to compare this alongside it with the other approach and see how they differ from each other. So we can see that when this agreement is signed, on the receivable version, we could recognize that income when it was signed. But if we're doing the work is done approach, no work has been done, so we can't recognize any income. There's also nothing in the bank yet and no debtor. Just nothing in the accounts at the point in January. Now in February, when the money is received, we still can't recognize the income because we haven't done anything yet, but we obviously have got the cash in the bank. So because we can't recognize the income, we recognize a creditor or a liability. It's also called deferred income. And you can see that there is the minus 100,000. So you can start seeing the differences here. We've got the money in the bank, but we are not recognizing any income yet. So if we look now at June and we compare and contrast. So we finished activity 1, and in the agreement, the standalone amount that related to the value of doing, or the estimated costs of doing activity 1, was 40,000. So when we finished activity 1, we can recognize income of 40,000. And what we've done is we've transferred that from the liability. So you can see the liability has gone down from 100 to 60. The income has gone up from 0 to 40. Now the amount we spent hasn't changed. It was still 38,000. So the surplus then shows as 2,000. Now that's a lot lower than the 62,000 on the green side, but it's still not matching. We're not just recognizing income to the extent that we've spent it. And there still might be a difference between the income that we're recognizing and the costs that we are showing. The fund balance is again equal to the surplus of 2,000. So finally, when we get to December and we've finished even the second activity, things look pretty similar. We bring in the extra 60,000 of income because we finished activity 2. We've spent the remaining 62,000 shillings. The cash has gone down. The liability is fully released. No surplus, no fund balance. So with all the timing differences have gone, everything looks the same. Now, obviously, that example is really simple. It's as if the grant year and the financial year are the same. It's as if you spend every penny. There's a lot of complexities that I haven't dealt with, but I wanted to just show the fundamental difference in timing between those two approaches. Now, this is quite a hot topic, and there's a few factors that we've been considering very strongly as we've been thinking about the different approaches. So the first and probably most important is the readers of the financial statements. These financial statements need to be understandable by accountants, by non-accountants, I mean. And the income accounting that you do has a big impact on some numbers that users might look at. So the first is liabilities. When a user looks at the financial statements and looks at liabilities, they're often wanting to answer questions about risk and liquidity and things like that. The second is a surplus, and sometimes users, I would say wrongly, look at the financial statements to try and get a sense of performance. Like if you've got a surplus, big surplus, then maybe you're not spending all your money. And if you've got a big deficit, well, maybe you're not managing well. And in fact, that might not be the case. But surplus is a number that users look at. The second and the third one here is the fund balances, especially the unrestricted fund balances. And they look at that to discern health and resilience of the organisation. So that's one factor. Another factor is thinking about it from the angle of the preparers. What we've heard really is that they're most keen to have clarity and practicality. They don't want ambiguity and having to spend hours interpreting each grant and arguing with the auditors about how to treat it. There's also this aspect of simplicity, keeping it simple, considering the capacity of all MPOs, but especially smaller MPOs, that if it's too complicated, it just becomes impossible to implement. The third really important factor is accounting concepts, and we can't change these. These are written in stone. So the technical definition of a liability is really important here, and it's sort of technical language, but it says that income can only be deferred. We can only put it on the balance sheet as a liability if there is a present obligation. Now that can't be changed. So what the conversation becomes is really, how do we know when we have a present obligation in the context of grants? Donors are an important factor to consider. They're keen to have reconciliation and assurance, and where possible consistency with the donor reports. That's their sort of primary concern from what we've heard. And finally, sector trends. I'm sure you've probably been hearing about conversations about localization and accountability as hot topics in the sector at the moment. How can we best support, best practice in grant making with our proposals? We don't want to be stuck in the past. We want to be future friendly with whatever proposals we come up with. So those are just gives you a flavour of some of the factors that we have to feed in as we're thinking about what to put into INPAG. So when Exposure Draft 2 was issued, my CEO, Christine So, she's the CEO of Humentum, she said this: accounting for grants opens up questions about risks, liabilities, rights and obligations, which are fundamental to shifting power in the sector and localization. The proposals create a fantastic opportunity for the accountants, lawyers, compliance folk, local organisations and thought leaders in this space to come together and consider the implications. So this is more than just an accounting conversation, and yet it's about accounting treatments. And so I really wanted to try and bring this to accountants, but also non-accountants who are able to engage with some of the technical language and inform the proposals. So one of the conversations that's happening around localization is this need for equitable partnerships when we're talking about shifting power. And if you think of a sort of old-fashioned grant agreement, it's the donor has rights and the recipient has obligations. That's what it feels like. But in an equitable partnership, both the grant provider and the grant recipient have rights and obligations. And that's the sort of language that we've built into INPAG. Both parties should have rights and obligations. Now, of course, there is a vast spectrum of practice in the ways that grants are made, the different types of terms and conditions, grant making philosophy, and hopefully there are new types and ideas and innovative grant practice out there as well. Now, to try and keep things simple, we have gone for a binary classification of all the different types of grants. That doesn't mean that grant making has to become more simple. It just means that for the purposes of understanding whether your grant is treatment 1 or treatment 2, we want to try and simplify that. So there's only 2 types of accounting treatment, therefore there can only be 2 classifications of grant in INPAG, and we need to find a way to help people discern whether the grant they're looking at is one or the other. So what are the different types of grant arrangement in INPAG? Basically, it's either an enforceable grant arrangement or it's not. That's the binary. So an enforceable grant arrangement, that's an EGA, or if it's not that, then it's an other funding arrangement, an OFA. And in this case, the EGAs, these enforceable grant agreements, are the ones that are recognized using this deferral approach when the revenue is recognized as the work is done, as the deliverables are satisfied, as the obligations are met, if you like. So that's the one where we were recognizing 40,000 when we'd done activity 1 and recognizing the 60,000 when we'd done activity 2. The other type of the other funding arrangements, all other ones, and in that case, that's when we use the other approach. We're recognizing the revenue as soon as the MPO controls the resources, which might be just before the resources have come in or when they're received, basically when they're receivable. So let's have a look at what it means to be an enforceable grant arrangement, because this is a very critical definition in INPAG. So in order to meet the criteria, both parties to that grant arrangement have to have both rights and obligations. So it needs to be a grant that is enforceable through legal or equivalent means. Crucially, it must contain one or more enforceable grant obligations or deliverables, the things that the NPO has to do in order to have a right to have the income. And that right is called an enforceable grant obligation. That's the name for the deliverable, an enforceable grant obligation. So let's unpack this term EGO, enforceable grant obligation, because it's really important. It's basically the required deliverables that are in an enforceable grant arrangement. It's not the same as a restricted. It's not the same thing as you've been given money for a particular purpose. Although the understanding is that all EGAs would be restricted, it's not also the case that all restricted grants would be EGAs. It's tighter than that. So in this case, the required deliverables are the grant recipient's undertaking to achieve a specified outcome, carry out a specified activity, use the resources internally for a specified purpose, or transfer resources to a service recipient. And that's the term that we've used. In some cases, it's a beneficiary, but that's obviously a term that the sector is moving away from for all the right reasons. And service recipient is the term that we're using. Now, crucially, where this EGO exists in a grant arrangement, it creates a present obligation for the grant recipient. If you remember from a couple of slides back, that's the technical term that accountants use for when there's a liability. There, you have to recognize a liability because there is a present obligation. Likewise, the grantor has the opposite side of that. It has a grant fulfillment right. It's like a contractual duty, if you like. But it's different just to saying, I promise I will spend money on this activity. It's saying, I promise I will achieve this activity. And that's quite a subtle difference. So there is a lot of jargon involved in this, I'm afraid. So let's see if we can unpack some of these terms. So the first is enforceable grant arrangement. This is a type of grant in INPAG, and it's effectively a mutually enforceable grant award that includes required deliverables. It's got to be enforceable, legal or other means, and it has to include some required deliverables that the MPO, the grantee, has to do to have the money associated with the grant. Now, these enforceable grant obligations, what we call EGOs, this is effectively the required deliverables within an award. What is the thing that the MPO has to do? They're also sometimes called milestones. And what's crucial, there should be consequences for non-delivery. And if there aren't any consequences, then maybe it shouldn't be an enforceable grant arrangement. Now, what's really key here is that what we're not talking about here are compliance obligations like submitting monthly reports or following procurement processes or not committing fraud or certain prohibited items. It's not enforceability on those areas. This enforceable grant obligation is the specific outcome or end point, the thing that the grant is supposed to achieve in terms of its purpose. And if there are no consequences for not doing that, if you spend the money right and in good faith, but you don't achieve the end point and there's no consequence, then you really need to think about whether this is actually an enforceable grant obligation. Now, another funding arrangement is every single type of grant or donation that is not an EGA. Now, crucially, this could be an enforceable restricted grant. It's not that they're not enforceable by, it's not that all OFAs don't have any enforceable parts to them, elements, but they don't have the enforceable grant obligation. So, as I said, if you spend the money in good faith, all of the money on the agreed activities, and yet the desired outcomes weren't achieved, that might not mean that you have to return the money. There might not be consequences for that. It's just a learning journey, and you're in a partnership working together to achieve agreed goals. That could be an OFA. It wouldn't have to be an EGA. So now a couple of terms that are used: restriction and constraint. Now we don't have, as at ED2, we don't have very tight definitions on these words yet. But the general meaning is that the funds are given, but they have to be spent on something specific. It could be as vague as they have to be spent on education in Vietnam. It could be as specific as they have to be spent on these specific activities that we have agreed. So that's restriction, constraint. Just to say, it's not the same thing as a required deliverable. You can have a restriction on the way that money is spent, which but without having a requirement that a specific outcome is attained. Another term that's used is the grant fulfillment right. So if the grantee has this required deliverable or EGO that it has to do, the other side of that, from the donor's point of view, is that it has a right for those required deliverables to be done. So that's another piece of jargon that you might find as you're reading this. The standalone amount is the estimated value, usually the budgeted amount, for each of those EGOs or required deliverables. So in the example we were looking at earlier, that's the 40,000 and the 60,000, which is the sort of cost allocation to activities as per the budget. And finally, what INPAG calls administrative tasks. Sometimes in the sector, quite often, they're called compliance obligations, such as it could be sending in monthly or quarterly financial reports or narrative reports, or undergoing audits, or following specific procedures, or compliance obligations is the term that we often use in the sector, but in INPAG they're called administrative tasks to distinguish them from enforceable grant obligations, which are the required deliverables. So there we go, there's some jargon. Hopefully that can help set the stage for what's coming next. So let's go through a kind of decision tree to find out how you work out what kind of grant you've got and therefore what kind of accounting you have to do. So the first question is there an agreement that has any terms affecting how the MPO can use the resources? And if there isn't, then it's basically some kind of general donation or a completely unrestricted grant. And the accounting is this recognize the revenue when the MPO controls the resources, i.e. when it's receivable or received. You recognize all of it when you get it. So the second question then is, if the answer is yes, if the agreement does include terms affecting how NPOs use the resources, then we have a second question. Do the grant provider and the grant recipient both have rights and obligations that are enforceable? And by obligations, we mean enforceable grant obligations, these required deliverables. And if the answer is no, that this agreement that does have, it might have terms that say how you can use it, but it's not meeting this really tight definition of an EGA, then it still goes back to being an other funding arrangement. That's really important, and that can feel a bit odd. I've got an agreement that does include terms that affect how the NPO uses the resources, yes, but it's still classed as an other funding arrangement. Now, there could be restrictions or constraints within that agreement, but it doesn't affect the recognition of when you do the accounting. Just because there's a restriction or a constraint doesn't mean that I have what's called a present obligation and that I put that grant as a liability on my balance sheet. The presumption is that it's going to be spent according to the requirements of the grant agreement, and it's only if there's a subsequent breach that there might be a liability. So restrictions and constraints in there by themselves aren't enough to require that complicated accounting. We're still in the simple accounting, recognize it when you've got it, and then spend against it. Now, if the answer is yes, and we do have this type of grant that has an enforceable grant obligations in it, then we have to use this income approach of recognizing the revenue as the work is done. Recognize the revenue as the EGOs are met, and it's called a 5-step model. So this is more complex. So we've basically got complex accounting for these specific types of grant, which are called enforceable grant arrangements, and simpler accounting for everything else. So this is the binary approach. It's either an EGA and has this complex accounting, or it's not, and we have simple accounting. So all the different kinds of grants in the world are just split between are they an EGA or not. So this has some really significant practical considerations. In these EGAs, these very specific types of grants, there must be rights and obligations on both parties. And it needs to be really clear in the agreement that there are rights and obligations and what those rights and obligations are. So there also needs to be clarity over consequences. What happens if the grantor doesn't pay when they're supposed to? What happens if the grantee doesn't deliver? What are the consequences? And if there are no consequences, then it's hard to really argue that it's an EGA. You need to have these standalone amounts, like we talked about the 40,000 and the 60,000 for the different activities. It's easiest if they are specified in the agreement. If they're not, then INPAG says you have to do best estimates. And monitoring. So the grantor can't recognise the expense until it knows that the grantee has done the required deliverable, has fulfilled its EGO. And that means that it needs to be monitoring. It needs to be getting reports. It needs to possibly be visiting or checking according to its own accounting timetable rather than the grantee's programmatic timetable and or risk level. So that's quite a major practical consideration. And then just to mention again that these other administrative requirements of just providing, requiring monthly reports and things like that are not considered to be a grant, what are they called? Grant rights, grant fulfillment right. That's just administrative, the normal requiring of accountability reports. So I hope that some of that has raised, ideas in your head about things about that you like or things that you don't like. And please do use this opportunity to share that, because we need to hear from the global community about aspects of this that they like and aspects of it that they don't. So you do this by going to the website ifr4mpo.org/have-your-say, and the deadline is the 15th of March. When you go there, if you scroll down, you'll see how to submit a response, step 1, and there's a document that you can download called a response template. It's just a Word document. Now, if you scroll through that document, when you get to about page 7, this is the relevant part for what we've been discussing today. Question 4 is all about revenue and relates to section 23 of INPAG. And you can see there, it says question 4 at the top, and then there's A. Question A, there's some references. G is the references to the actual guidance itself, and there's a box for you to write your response. So I'll just go through what some of these questions are. You don't have to answer all these questions, and also you don't have to be limited to these questions in terms of what the feedback you can provide. But they're put there because this is what the technical advisory group are particularly keen to find out what people think about, and hopefully this will spark some ideas in your head. So question 4A, section 23 part 1 and section 24 part 1. 23 is on revenue and 24 is on grant expenses. They introduced some new terminology relating to grant arrangements. Yes, we've been through some of that jargon. Do you agree with the terms enforceable grant arrangement and enforceable grant obligations and their definitions? So you might like the definitions but not like the actual terms. You might like the terms but not agree with the definitions. If not, what alternative terms would you propose to achieve the same meaning? What are the practical or other considerations arising from these definitions? So this is a really big one, and I suspect a lot of people might have opinions on that question. Question 4B. Do you agree with the structure of section 23, where part 1 is focused on grants and donations, part 2 is focused on contracts with customers, and a preface that brings together the key principles and information about how to navigate the guidance? So sometimes basically the accounting treatment for contracts with customers is the same 5-step model as the accounting treatment for EGAs, which are grants. And we debated long and hard about how to sort of organize it in the section. But you can see there, that's the explanation of how we've ended up. But do you agree with that? Is that a helpful structure to the section so you can find your way around? And then question 4C. Do you agree that revenue is only deferred where the grant has a present obligation in relation to the revenue received? What other circumstances could revenue be deferred, and what's the conceptual basis for this proposal? So if you're somebody who likes the idea of matching, or you like the idea of if a grant relates to a future year, you'd want to defer it, things like that, this is your place to say what you would like and why, and what's the conceptual basis for it. Because as we mentioned, the accounting concepts that we've tried to apply is that you can only have a liability if you have a present obligation. So we're trying to unpack and see if there are any objections to that. So then question 4D, the revenue recognition model for enforceable grant arrangements requires that revenue is allocated where there is more than one enforceable grant obligation. Like if we had activity 1 and activity 2, that 100,000 was allocated to the 40 and the 60. Do you agree with the allocation methods identified? I haven't talked about them in this video, so you could look at that in more detail. If not, what methods would you propose? What are the practical considerations? And then questions, I've missed some out because these are the ones that I think are most pertinent to the issues I've talked about in this video. Question 4H, do you agree that administrative tasks are generally not separate individually enforceable obligations? i.e. they're not required deliverables. They're rather a means to identify or report on resources in an enforceable grant arrangement. If you don't agree, provide examples where administrative tasks are an enforceable obligation. Then we're into question 5 is about section 24, which is on grant expenses, when a grantor is making grants. Do you agree that all expenses on grants and donations can be classified as either an enforceable grant arrangement or as an other funding arrangement? Basically, do you agree with this binary classification approach? If not, provide examples of which expenses or donations would not fit into either of these classes. So this is again from a grant maker's point of view, but it would also work from a grantee's point of view. Can you think of examples of grants or donations that really don't seem to fit into either box, either of those binary boxes? If they don't feel comfortable in either, we'd really like to know about that. And then the last question I've put here: enforceable grant arrangements are required to be enforceable mutually, that is, both ways, through legal or equivalent means. Do you agree that regulatory oversight and customary practices can be sufficient to create an enforceable grant arrangement? If not, why not? What weight should be applied to these mechanisms? And this is particularly, I think, relevant in our sector where, you know, people don't tend to sue each other, right? We don't, grantors don't sue their grantees unless there's some terrible fraud, but not for non-delivery. Usually it's not suing. So, yeah, to what and what right does a grantee have to sue the grantor if the work has been done but they don't pay up, if they hadn't got the money in advance? So there's, I think, some really big questions around enforceability here and what that looks like in the sector. Can it be sufficient to create enforceable grant arrangements at all? So yeah, big question there. That's it. Well, it ended up being a bit long, sorry, and probably a bit more complicated than I'd hoped. But the idea is to help sort of unpack some of these complicated terms and give you spark some ideas, some reactions, and give you the tools to respond. Please reach out if you've got any questions, and I'm really happy to help. Thanks a lot. Bye-bye.